Well, despite today's tech turnaround, our next guest is warning that the market isn't out of the woods just yet. Tony Dwyer is Canaccord Genuity's chief market strategist. Tony, it's nice to see you. And it's interesting because I don't usually think of you as very cautious. I think of you as very bullish generally and optimistic as a strategist. So what's different now for you?
Yeah, I like to wake up that way. And if you look at over the longer term, I still am that way. Ultimately, Sarah, as you know, the market correlates to the direction of earnings. And unless you go into a negative economic backdrop, that direction is positive. So ultimately, as long as the Fed hasn't inverted the curve and shut down the availability of money, you do want to be a buyer. The question is, when do you not necessarily want to chase? And as you know from the closing bell, it's nice to have you on both shows. As you know from that show, we found that when the S&P 500 is up 25% in a calendar year since 1980, it's always, each time it's had, it can always be different this time, but each time it's had a correction. It's a median 5.2% correction early in the year. So our whole tactical policy into this year was to get the market to come in a little bit and maybe attack it as it got oversold using some of our key indicators.
Are we at that point yet? Did it get oversold?
No, it didn't, Sarah. So we're down 2%. So your median gain is down 5.2%. What we use is, I say very openly to the team, as they know for over the years, I use the percentage of S&P 500 components above the 10-day moving average as a guide. That didn't get oversold despite how bad it felt yesterday morning. And I use the VIX. I use a 10-day rate of change on the VIX. And when it gets over 50, there's too much volatility. I know Pete and I have talked about this one before. So, you can get a bounce. Clearly, you're getting an oversold bounce. I think this whole story on rates has become very interesting. Somehow the market participants or people like me come on TV, and the Fed, who is yet to stop actually buying bonds, is going to raise rates 4 times. And even though they're still buying bonds, in the middle of the year, people were saying that they're going to start dwindling down the balance sheet. Now, maybe that can happen. But if you're going to start,
they're talking about it.
The balance sheet, why would you still be buying bonds 2 or 3 months in front of that? So later in the year, they may. So my whole point is, I think that expectations about the Fed have maybe gotten a little bit ahead of themselves, which allowed for an oversold bounce in some of these tech names.
So what do you do with all of this volatility and the uncertainty on rates, where yields are moving, and with, as you say, more downside ahead because of some of the levels on the VIX? Where do you want to be?
Well, if you're looking for a 5% downside, you don't play the downside. It just means that if you do have cash to deploy, you wait. And as you know from, honestly, back in October in the closing bell, our whole theme is banks, tanks, shanks, and cranks, which is the financials, the industrials, the materials, and the energy. Now, they've become extended. We've also found that over the course of the last 2 years, and actually you got to go all the way back to the Great Recession to make it, to look at it again, but when the Russell 1000 value has outperformed the Russell 1000 growth to this degree on a 10-day rate of change, it reverses. And that happened yesterday, carried forward to today, and it could continue for a little bit. But eventually, we do want to be long those more cyclically oriented names throughout the year.
And finally, really quickly, we're about to kick off earnings season. Does that change the trajectory here?
So the big question is, Sarah, are margins going to be impacted by inflation? And I think we've done a study that shows that margins don't peak on a macro level. Of course, companies can be affected individually. From a macro level, margins, S&P operating margins, do not peak until the end of the cycle when the top line begins to slow. When the top line is still growing pretty well, you can pass along the price increases. So if you look at the correlation between S&P operating margins, one of the best correlations, or it's actually an inverse correlation, is to the unemployment rate. When unemployment rate peaks or bottoms and begins to lift, it means that people are going to spend less money. That shortfall in revenue ultimately leads to a compression of margins. But until then, I think we should get upside in earnings, not just from too much expectations of margin pressure, but also the impact of buybacks.
Tony Dwyer, always great to check in with you on Closing Bell and on Fast Money. Appreciate it.
Great to see you, Sarah. Have a great day.
You too. Let's trade this, Karen. What do you make of Tony's call on the market?
I kind of agree with him, I think, which is he's saying, did I interpret it right, sort of a short-term negative in that he doesn't think things are oversold. But I don't look at the market as a monolith. I do think there's names to buy out there that, you know, something that's sort of like a Walgreens Boots that's not so, you know, the PE multiple is cheap. I think that FedEx, which, you know, I've been in for a long time, it went up north of 300. I didn't sell it, did a bad job there, but I still think it's cheap here. It's good to own. I think the banks are good to own. The only thing I don't like about the banks is that going into earnings, when the stocks do well, people are usually disappointed with the earnings, and so they sell it off. But I'm not going to try to trade around that. I'm long banks going in. I know this will happen. It happens every time, or just about every time. But I look at it in the long term, and I think I want to be in the banks. I think there's great value there.